Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. The market has staged a pretty sizable rally over the last 30 days. The S&P is up a little over 9% during that period of time, still down for the year, but making up a lot of ground. And investors are anxious saying, if this is the rally, I don't want to miss it. Should I be putting stocks back to work? You're hearing analysts talk about bottoms in the market and buying low. And when we look at the big historical data, it's starting to suggest otherwise. It could in fact be what we call a bear trap. There's a lot of these bear traps when you're in these kind of sustained bear market environments that kind of entice investors in, only to find out the problems aren't fixed, and then the market goes lower from there, and then they end up losing a lot of money. So I'm going to share some of that data with you today. More specifically, when I talk about these bear traps, I'm really looking for rallies that happen in the stock market that are greater than 5% only to retrace themselves down to lower levels. And if this ends up retracing itself, it's not the first bear trap of the year. It would actually be the fourth bear trap for 2022. If you look at this chart, which is a year-to-date chart of the S&P 500 as of August 17th, there's actually, here are the four bear traps. So there was one at the end of January where the market went up 6% only to go lower. There was one in March where the market went up 11% only to go again to lower levels. One in May that was up 9% and then retraced itself. And as we sit here today, it's up about 13% off those lower levels. And we're in this, are we going to get this bear trap retracement again? The question then becomes, what are you looking for to determine that the bear market's over and the next bull rally has begun? And to me, it's fairly simple. You kind of look and say, what were the issues that drove the bear market in the first place? And are you making meaningful progress towards resolving those issues? They don't have to be fully resolved yet, but you have to be making meaningful steps to resolve those issues. If that's starting to happen, then the answer may very well be yes. If the answer to that question is no, we're making progress, but not meaningful progress, then you have to be very careful about investing in risk assets. It's not really a secret to anyone right now what's causing all this market pressure and volatility. It's inflation, right? We're all waiting to see when inflation is going to start coming down so we can get the all clear. Now, what really sparked a lot of this rally was we got the July inflation reading, which was 8.5%, which was lower than June 9.1. So everyone's like, yes, maybe we've seen the peak of inflation. But I remind people, 8.5 is still a horrible number. That is way too high. And where we kind of start to see victory in the number is if you have to get inflation below the wage growth rate, which is what people are making. And the wage growth rate right now is about 6%. So people are only making 6% more, and the inflation rate is still 8.5. That means it's still going to keep eating into the consumer, and the bedrock of our economy is the US consumer spending money. So again, it's going to take more time. And if we're just dropping at 0.6% every month, it might not stave off the recession in 2023. You have to also think about the math of these CPI readings, that consumer price index. Because when I say 8.5% in July, that means prices went up 8.5% versus a year ago. So let me explain this in an example. So if I could say, hey, I will sell you this coffee cup for $100, and you would say, no way, it's not worth $100. But then I wait and come back to you a year from now and say, hey, I'll sell you this coffee cup for $102. It's only gone up 2% over last year, but you would still say no because you'd say, well, that's still too expensive. It's still not worth that. Think about that concept. If we go back to last year, let's say August of last year, the inflation rate was already going up by over 5%. So arguably, prices were already rising above the Fed's 3% level. So if you say, hey, those were elevated a year ago, and let's say they go up another 8.5%, that is the same example. So I would naturally expect via the math that the inflation rate will start coming down, not because people can afford more stuff. If you look at things being more pricey and they just went even more expensive, that could still work against the consumer. One of the strong data points we're looking at right now is something called the yield curve to determine what the probability is of a recession in 2023. And it's throwing off some very negative signals. Anytime the yield curve inverts, historically we see a recession within the next 6, 12 to 18 months. And if you look at the chart, this is a chart of the yield curve going back to 1970, where you see those red arrows on the chart, that's where the yield curve inverts. And those gray areas are all the recessions we've seen. So you can see the consistency. There's an inversion, recession, inversion, recession, inversion, recession. And you look all the way on the right-hand side, we are inverted right now. But the other thing you can take away from this chart is this. There's a gap. Like, look at the gap and the timing between the inversion and when the gray bar shows up. So it's not like, hey, we've inverted, where's the recession? Typically the inversion occurs because the Fed is raising rates, it's pushing short-term rates higher, but it takes 6, 9, 12 months for those interest rates hikes to have an impact on the economy. Now, I'll have some clients ask the question that when there's a yield curve inversion, if you're telling me there's a 6, 12, 18 month gap between when the recession begins, shouldn't we take advantage of this rally and just sell everything before the recession starts? And my answer is usually whoever can do that consistently and accurately across multiple market cycles would manage all the money in the world. But the tricky thing is it's really difficult to determine when those recessions are going to show up and how they're going to show up. And typically the market will sell off in advance before the recession's actually declared. So if you think it's coming, you got to be very careful about being aggressive going into it. Having been in the investment industry since 2002, you learn a lot of lessons throughout these various recessions. I saw the tech bubble bust, saw 08-09 housing crisis, saw the Eurozone crisis, the most recent COVID recession. You learn lessons along the way. And I would say the first one is don't try and exactly time the recession. Very difficult to do. Number two is when the economy comes under extreme pressure, things tend to break that are not expected. For all the forecasting we're doing to say, hey, recession, housing market could slow down, all this other stuff, there's usually something that breaks that then drives more fear into the market and drives the market lower. And no one can say at this point what that's going to be. And I think the third lesson I've learned is do not underestimate the power of monetary and fiscal stimulus. I want to spend some time elaborating on that third item, which is underestimating the monetary and fiscal stimulus, the power of the government, that when we get into trouble, they can start printing money, they can bring interest rates to zero. That's why when we're in the doldrums and things look really dark and they reverse course and start these stimulus, usually people are late getting the rally because things haven't gotten good yet. But as soon as I found that the Fed and the government turns their eye and says, we are going to stimulate this thing, they have a printing press. They're usually successful. But the same is also true if they want to slow things down. We're in an inflationary environment, right? They're intentionally trying to slow down the economy. They're raising rates. They're taking away liquidity. The stimulus programs are gone. Do not underestimate the power going the other way. There is a point I mentioned earlier that's part of this conversation that I wanted to come back to, and that's with the Fed raising rates and the delay between when the rate hikes happen and when the economic impact happens. So again, the Fed's raising rates to try and slow down the economy. It makes car loans more expensive, mortgages more expensive. That's kind of their tool to slow things down. Well, the day they do the rate hikes, it takes time for those interest rates to work their way through the economy. So a lot of economists predict that after they do a rate hike, the economic impact is not felt 6, 9, 12 months after that rate hike takes place. So you hear about all these big rate hikes now, you won't see it impact the economy until potentially midway through 2023. So that, again, that's why you got to have caution here. In talking about Fed rate hikes, there is something different about this cycle, and it's really the magnitude of the rate hikes. When you look back in history of what the Fed has done in the past, usually they like to do nice, easy rate hikes over longer periods of time because it gives the economy time to digest each rate hike. They have not had the luxury of doing that this time around because inflation got so far ahead of us. So if you look at this historic chart of the Fed funds rate, look back at 2004, that was one rate hike cycle, and one in 2016, they look like a staircase, nice and easy. But if you look at where we are in 2022, you can see where it looks more like a straight line or rocket ship up. And they're expecting that in the September meeting, they're going to raise again by 0.5 point to 0.75 point, which will move that line even higher. And you have to say, well, what does that mean 6 to 9 months down the road? There's a popular trading strategy out there called don't fight the Fed. Basically saying, listen, if the Fed is trying to tighten and slow down the economy, they're probably going to be successful at it. Vice versa, if they're out there stimulating, trying to get the economy to grow, they're probably going to be successful at that too. So traders will develop trading strategies saying, hey, if they're tightening and they still have a long ways to go and the economy has more to slow down 6 to 9 months from now, that's probably not a great time to be in risk assets. You'd rather be in risk assets when they're at the precipice and they're about to start lowering rates and breathing oxygen back in the economy. That is typically the time. When you look at their target rate of inflation is normally 2 to 3%. We're sitting at 8.5%. That probably means they have a long ways to go, a lot more tightening before they're ready to start the easing process. Here's the big data point we're also looking at. And I have to credit Rob Mangold in our office for finding this data and bringing it back to us. But essentially, anytime the Fed has had to bring down inflation in history, they have never successfully brought down inflation over 2% without causing a recession. I will say that again. Throughout history, anytime they've had to reduce inflation by more than 2%, they have never been able to do it without escaping a recession. So you have to question, if we're at 8.5 and they're trying to get down by 3, are we going to be this anomaly this time? We've spent a lot of time talking about monetary policy in the Fed, but there's also fiscal policy, which is what the government and Congress controls. Similar to COVID, they decided to pass laws that issue stimulus checks, they enhanced tax credits, they had the PPP program, all this way to inject cash directly in the economy to help it grow. Now, we have become very accustomed in the US to short recessions. We have severe ones like 08, 09, but when you look at that, we almost lost the entire financial system and the market bounced back. That's because the government took all those bad loans away from the banks, put it on their balance sheet, did all these stimulative measures, putting cash in. Same thing with COVID. COVID, we had an all stop at the global economy. Everything stopped. The market went down 34% in about 2 months. But then by the end of 2020, the same year that COVID started, the S&P 500 was up 16% this year, which is a shock to everyone. Again, if the government wants to stimulate, it's going to work. Now, the reason why I'm talking about fiscal policy here is usually fiscal policy will come to the rescue when we need help. So if we end up in a recession next year and it's inflation driven, here's the difference. In the 70s, when they had hyperinflation, the government made the mistake of, well, people can't afford higher prices, so we're going to give them subsidies for the higher gas prices. We're going to give them some money. And they learned the very hard way that if there's inflation and you give people more money, which allows them to keep paying higher prices, what it does is it creates more inflation. It actually makes the problem worse. So I think that's the toughest part is when we talk about recession in 2023, it might not be one of these V's that we're used to because the government can essentially step in and print money to help people because that could just be a repeat of the 70s with more inflation and you end up on this hamster wheel. Well, it's never fun to have conversations like this about recessions and economic data falling off and uncertainty in the future. It's obviously way more fun when we're in growth environments and everyone's making money. We just have to be realistic about what we expect out of the economy over the next 12 to 18 months and not get caught up in emotion of, oh, is this the rally? Is this the rally? Is this the rally? Because I see too many people say, well, they try and justify it by saying, well, this time it's different because X, Y, and Z. And I've been in the industry long enough to say, rarely is it different. Yes, sometimes things are slightly different, but it's not that different that all of a sudden all these anomalies are popping up every other day. So just be careful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.